Welcome to Crash Concepts, where the economy, energy, and the environment are explored. Up next, fresh ideas and insights into the factors that are driving the world and shaping your future. Presenting information you can't afford to live without, here's Chris Martenson.
Today we're speaking with Axel Merk, President, Chief Investment Officer, and founder of Merk Investments. Axel's a noted expert on world currencies and manages several mutual funds that manage currency risk for investors. For years, he has been an outspoken critic of U.S. monetary policy, warning investors that the current course risks seriously devaluing the dollar. The past few years have proven his warnings to be accurate. He is also the author of Sustainable Wealth, a very readable guide to understanding our macroeconomic environment, the risks today's investors face, and how they can manage their finances to achieve financial stability. Very important in today's world. Axel, thanks so much for making the time to join us today.
Hi, good to be with you, Chris.
Let's jump right into it. The U.S. dollar is trading at its lowest level since the carnage in 2008, and there are many voices, yours and mine included, warning it could go a lot lower. So, if you could, recap for our listeners right here now how we got here, and what's your outlook for the dollar?
Well, the dollar has really been on a very, very long-term decline for decades, and sometimes it puzzles me when people say, "Oh, I'll sell the dollar and get out of it if and when it does come down." I don't know what they're waiting for, and that trend has obviously had some ups and downs and been accelerating in recent years. In recent times, we've had this major challenge that we're trying to grow at just about any cost, whereas our consumers, they would like to really have a break. And it's not just now after the financial crisis. After the tech bubble burst, after 9/11, we decided to keep America rolling. And what happened is that we was just going out on an all-out spending spree in an effort to get this economy rolling. But when the market, or when consumers in particular, don't really like to spend, what happens is you're throwing a lot of good money after bad, and that money doesn't really stick where it's supposed to be. Consumers like to downsize in the current environment. If they were left up to their own, they would to downsize in their homes. Of course, that means foreclosures and bankruptcies, which our policymakers don't like. So they throw a lot of money at the problem. Consumers don't want it. And so the money goes where you have the greatest monetary sensitivity, that is gold, that is outside of the dollar, into Australian dollar and other regions in the world. And we're just better at spending and printing money than the rest of the world is. And it's a trend that's been intensifying in recent years.
Well, I mean, part of that trend is supported by being the world's reserve currency. That's an exorbitant privilege, perhaps one that's been abused lately. So in my perspective, every single recession we've had to this point, deleveraging has been part of that process. This time, it seems like the fiscal authorities at Washington, D.C., and the monetary authorities at the Fed, they seem bent on making sure that we don't deleverage this time. What's driving that?
Well, if we allowed market forces to play out, we would have the adjustment that from a purist point of view would be the appropriate thing, that the folks who've made wrong decisions, they need to declare bankruptcy. The problem is many people made wrong decisions. Millions of homeowners are underwater in the mortgage. We would have a depression, and that is something that our policymakers don't want. And now we have Ben Bernanke, who says he's a student of the Great Depression, and he thinks he has all the recipes on how to not redo all the mistakes that we have. And think about the types of things Bernanke has said, and including testified in Congress. He has said going off the gold standard during the Great Depression has helped the U.S. recover faster from the Great Depression than other countries, meaning if you debase your currency, you can get faster growth. If I take away half your money, as far as purchasing power is concerned, you have a great incentive to work. He has said a weaker dollar is historically not inflationary. We disagree, but that's his viewpoint. On top of that, he is buying government bonds. So when you buy government bonds, those securities are intentionally overpriced, signaling to investors they should rather go overseas where there are less manipulated returns. So both in word and in action, he wants to debase the dollar as one method to spur economic growth, and he needs that because we want to have consumers that spend, and consumers who are underwater in a mortgage are not going to spend. Now, businesses have been much healthier. They have gotten on their feet, done the right things much faster, but consumers want to deleverage, and we don't want them to deleverage because we have seen in any other country in the world that has a housing bust, we have economic stagnation for many, many years. Now, we have the same thing, except we're trying not to have it by throwing a lot of money at the problem, except that all these theories that Bernanke has, unfortunately, don't work quite as well in practice, and that's why we have inflation coming in, that's why we have the dollar weakening, And the only response we get is we'll throw more money at the problem because it just can't be the way that the market wants it to be. It has to be the way the Federal Reserve wants it to be.
I've been concerned that yes, you're exactly right, that Bernanke had a theory, a thesis, right, developed at Princeton. A lot of intellectual thought went into it. I'm not sure how much real-world applicable practice went into it, given his career track. But let's assume he was right, in his thesis. He had a good one. I'm concerned that he's engaged in what I would call thesis drift, where he came in and said, listen, if we just throw a whole bunch of money at this, it'll pick itself up and carry on. And that hasn't worked. And so the response was, well, let's do QE2. And even there, we can say this is questionable in terms of its actual response to the overall economy. And it seems like he's ready, willing, and able to do anything necessary to prove his thesis right, where it might not be correct. It might be that the conditions in the 30s were very different from the conditions today, and all sorts of measures, being a net export nation, being a net creditor, being energy independent, et cetera, and so forth. There's so many differences that it's almost impossible to catalog them all. Where do you think we are in terms of the Fed's position right now? I know that you happen to have access to a former Fed official, if you can talk about that. And I'm wondering if you have any insights for us as to what the Fed is up to and where they're going from here.
Sure. Well, the one thing I have learned over the years that our policymakers are quite predictable, be that on the fiscal or on the monetary side. And I do think that Bernanke is pretty much following his playbook. I mean, one of the things he has said that one of the great mistakes during the Great Depression was to tighten too early. And as a result, we deepened then the Great Depression or had the second leg downward. And so he doesn't want to do that, and he wants to err on the side of inflation. Right now, I've been arguing that the Fed can get away with murder. And what I mean with that is that because this money doesn't really stick anywhere, all this money printing, yes, it shows up in the excess reserves in the banking system, but not all of it causes significant inflation. We see it in food and energy, but it takes a while to trickle through. The big concern I have is let those these policies work, and we get substantial economic growth. Well, what are we going to do then? If the Fed were indeed to mop up all this liquidity, Bernanke has argued he can raise interest rates in 15 minutes. Where are we going to be then? The challenge is we have too much leverage in the economy. Consumers are far more interest rate sensitive than they have been in the past, and as a result, will plunge right back down. So in the best of cases, we have a very volatile policy. And by the way, before I talk about our own former Fed president, who is our senior economic advisor, contrast that with Europe, where consumers stopped spending a decade ago. They were told a decade ago, there's no money for your pension. In the U.S., they were told the same thing, except in the U.S., they took out the credit card. In Europe, they stopped spending. And now the Europeans can raise rates, and they don't derail the economic recovery just because rates are a little bit higher. We simply cannot raise rates like Volcker did in the early 80s to contain inflation if it needed to be. We would have a revolution if we were to raise rates to 20%. It simply doesn't work. Now, you mentioned in-house, we do have Bill Poole as our senior economic advisor. He is the former president of the St. Louis Federal Reserve. He is the one who voted against the emergency rate cut in January of 2008. He also was the one Fed official who argued about bailing out long-term capital management. He's now a senior fellow of the Cato Institute. He's very much a free market thinker. He's also a very pure monetary economist. He's obviously been around some of the Greenspan policies, but he has a very straightforward way of thinking, and he makes for amazing discussions. And in particular, what he is very valuable for us for is he helps us understand how the Federal Reserve is thinking, how the dynamics may play out. He has an opinion on the dollar. He doesn't tell us what the dollar will do, but what he helps us do, he helps us understand how central bankers are thinking. And I think that's one way that we're a little different from other folks, is that while we criticize policies just as much as others might do, we actually try to slip into their shoes sometimes and understand how they're thinking, because ultimately it doesn't really matter what I think. It matters what the Fed thinks and what the Fed may do. And so as a result, I think it is very helpful to try to understand their thinking and how these dynamics may play out.
Oh, I completely agree. I've been saying repeatedly for a long time that investing is dead. We're all speculators, and what we're speculating about is what's the Fed going to do next? Since we have to guess at that, we don't really know. We do the best we can, but so much seems to hinge on what they're going to do next. And I've been following it just absolutely as close as I possibly can, but on pins and needles, ready to turn at a moment's notice if it turns out the Fed surprises me in some way. Surprise used to be one of the tools in their toolkit. It hasn't been for a while. Right now, they've been saying we're going to keep rates low forever, or indefinitely, and we're going to funnel more money in at the drop of a hat if we see more weakness. Where do you see the Fed going next, and what about this? What appears to be, at least in the public theater, a split in the ranks between sort of say what Bernanke's thinking on one side and what Fisher is saying on the other side, if I can classify it that way.
Sure. Well, a couple of things. First of all, let's keep in mind what the Fed's role is and supposed to be. The Fed's role is supposed to be to take away the punch bowl when the party gets to be too hot. The Fed is not supposed to be the cheerleader to kind of push on the economy at any cost. The Fed's role is to have a pursuit of price stability. Now, in the U.S., we have a dual mandate also to pursue maximum sustainable growth. But we've kind of forgotten that, especially because of the financial crisis, that the Fed is always there to bail us out, to help us. That is not their role. So to keep that in mind, first of all. Secondly, the Federal Reserve, as a current step, they have said that the quantitative easing, the purchase of government bonds is going to be finished this summer. Now, some people say that is an exit. By all means, that is not an exit. That is a pause. The securities they purchased create money that is in the banking system. The banking system is awash in money ready to be deployed. So that is a pause, and the most likely scenario is that they're going to just wait. There are huge numbers of excess reserves that are just waiting to be used in order to give loans to the economy, and they can be deployed any minute. And so they don't need to do anything beyond that. The Federal Reserve is easing and is going to keep the economy awash in money, whereas the rest of the world has been tightening. Now, as far as the dissent is concerned at the Fed, that's been growing. And of the voting members, Placer is really the most vocal one right now. But Charles Placer is by the way, a dear friend of our own Bill Poole, and I've met him and had discussions with him. He's a great man, but he is not somebody to typically dissent in public. He's also somebody who likes to work behind the scenes. And importantly, there's always this balance between the regional Fed presidents and then the governors. And the Fed presidents, they tend to be academics. They have very strong views sometimes. Sometimes they talk aloud. Sometimes they talk in quiet. But often and typically, they are not the ones who are calling the ultimate shots. That is up to Bernanke, to the chairman, Yellen, who is the vice chairman, and the folks who are in New York who are at the governing. Now, the Fed presidents, of course, they can raise issues, and possibly they can create dissent, and that can create a debate. But ultimately, with Bernanke has a strong will to pursue a policy, it will take a very great deal for those minority voices to be pushing Bernanke over. I don't think that is likely to happen. And what happened a few weeks ago is that we had like a dozen of Fed speeches come out, and first were all the Fed presidents that were more hawkish, and then came the governors who said, no, everything is fine, inflation is not a problem, and then people realized, oh my God, yeah, it's those governors who call the shots, and that dissent is there, it is a concern, but ultimately Bernanke is going to pursue his policies.
Well, and he was just very recently on record as having come out at the end of all of that noise that was coming out of the whole system and saying that maybe we would have QE sort of, is how I'm terming it, where they would continue to roll the maturing MBS paper into treasuries on a go-forward basis at $17 billion a month or something like that. A far cry from the $4.5 billion a day that's been pouring in under QE2, but still money would be flowing in. So you're saying that's keeping ample liquidity in the system?
Yes, well, there's going to be plenty of liquidity in the system. And one thing to keep this into context is that about obviously there are different ways people look at inflation. You can talk about inflation as just the money that's been printed, or you can talk about the money that's been used in the economy. But importantly, if you think about inflation, there are two major school of thoughts about what is driving inflation. What Bernanke thinks is that if we have a slack in the economy, if capacity utilization is not high, if unemployment is high, we cannot have inflation. And then there's the other school of thought that Placer and us as well subscribe to, that inflation is ultimately a function of inflation expectations. And while that may sound like a circular argument, what that means is that if people believe that the Federal Reserve, who's in charge of printing money, can contain inflation, then inflation expectations will be contained. But if the trust erodes in the Fed, then all bets are off. And in the 70s, for example, we saw that happening, that people thought, oh my God, inflation is coming through the system. We did have a slack in the economy. We did have unemployment high, yet you could have inflation, push cost inflation. And we are entering exactly the same era where we have Bernanke, who has explicitly stated last August in his Jackson Hole speech, he wants to have inflation move higher. And then he was upset the market didn't endorse him and he started QE2. He wants inflation expectations to move higher. He needs to have the price level move higher so that people are bailed out from the mortgages who are underwater. And in the early 80s, when Volcker said he's going to contain inflation, people didn't take him seriously, and it took a while. Well, now Bernanke said he wants high inflation. Same thing happening all over. The market didn't take him seriously, and by all means, we will get higher inflation, and at some point, the markets will realize that Bernanke was dead serious.
I'm still not entirely clear what he's looking for when he says he wants higher inflation, because is that inflation in asset prices? I think so, yes. Is that inflation in the traditional sense where all of the prices are moving up in a price wage spiral? I don't know if that's realistic at this point, because the wage component of that's broken, has been for a while. And inflation is actually very, very real depending on where you are on the socioeconomic spectrum. So for people, under the median income, it's very real what's happening to food and fuel right now. It's not transitory. It's actually quite punishing. So what do you think he means when he says he wants to see higher inflation? Is he really actually looking at the CPI or even their trimmed mean and thinking he's looking at a realistic measure of inflation?
They're not looking at what we think is a realistic measure, but what the Federal Reserve is looking at is they're looking at inflation expectations as they're priced into the market, which is the spread between the inflation-protected securities and the underlying Treasury securities. And there you can come up with a forward-looking inflation expectation. And what the Federal Reserve does typically, they say, all right, the next 2 or 3 years or up to 5 years we can disregard because that might be temporary factors. So let's look in the market what the forward-looking inflation expectations are based on how they're priced in the market. Now, of course, some of these prices are distorted because the Federal Reserve has been buying just those securities. But there, what you can see is that the inflation expectations were dipping just a little under 2%, depending on which measure you're looking at going forward, which is below the comfort level of most central banks, and since then have been moving steadily higher. But it is about 2% inflation that the Federal Reserve is looking for on that very crude measure that they're looking at, and Ben Bernanke wanted to have that move higher. Now, in my view, it's moved beyond even the comfort zone of a typical central banker. To your broader question of whether that is appropriate, of course, we have seen inflation in food and energy go up, and one of the things that people are not always aware of, that 1/3 of the CPI is the rental equivalent, is the value that you pay for. It's pretty much your rental expense or your housing expense. And of course, when you spend all your discretionary income on food and energy, you don't have much time to pay for rent. Now, of course, some people have moved to rental units and so forth, but still, the upward pressure on rental prices is going to be very much held back if unemployment is high. It's going to be very much held back if people don't have any money to spend on rent. And so, by all means, the measure of inflation that the Fed is looking at is going to be fairly well behaved. But in the meantime, what we have is we've had real wages not go anywhere for a decade. People are disenchanted. They're voting more for more populist politicians in the U.S., from the Tea Party on the right to others on the left. And what that means is that we're creating an environment where we are less and less likely to tackle the big issues, entitlement reform, that we need to tackle down the road. And that's just in the U.S. In the rest of the world, where we've exported our policies, we get riots, revolutions, and other things happening because the citizens are more disgruntled, and you can oppress your people, but if you don't feed them, they'll start a revolution.
All right, so and I totally get that in complete agreement. Well said. So on the monetary side, we have pressures on the dollar because we're holding rates between 0 and 0.25%, where Europe has just raised rates, where Canada has higher rates, where Japan has lower rates, but they have their own issues going on. China's hiking rates. So we've got there's monetary pressure as well. We're printing money like crazy still through QE2. On the fiscal side, what are your thoughts there? I don't want to get into any sort of a political debate, but the or discussion. When I look at the amount of money that they're talking about cutting, $38 billion, it's a laughable amount compared to how much new debt is printed every week, or the size of the deficit, let alone the overall budget. We also seem to have fiscal pressures that are going to be pushing on the dollar. How do those play in, particularly in this global economy now, where it seems like there's no safe place to run?
Sure. Two answers to that. In the short term, the absolute budget deficit has just about no correlation to the value of the exchange rate. We much more look at flow numbers, that are the current account deficit, the financing requirements, and so forth. But in the short term, we see Japan has, for example, a very high budget deficit, a huge amount of debt. Those numbers are not very relevant in the short term. But what matters a great deal is the sustainable of the deficit. And in the U.S., the math simply does not work. And anybody who looks at those numbers knows we're heading towards a fiscal train wreck. Now, politicians know that as well. Some of them still think that you can tax the rich and be able to somehow solve these problems. It simply does not work with the math. And so what we have to do is we have to tackle entitlements. We have to tell people that they have to work longer. By the way, when Social Security was first introduced, it was set at above the average life expectancy age. And we have to have people have skin in the game in healthcare, Medicare, Medicaid. And they're both Republican and Democratic ways of tackling those issues. But we need to have a debate on that. And luckily, some of that is starting to happen. Unfortunately, the proposal on the table by the administration doesn't do that. The proposal on the table by the Republicans is too radical given the political realities. But at least we're starting a debate on that. And S&P obviously has started in now by downgrading the outlook on U.S. debt. With that, hopefully we're pushing the debate more onto it. Now, keep in mind, no politician is going to change their mind on the budget simply because an analyst at Standard & Poor's decided to issue a warning. But it may put in motion a debate. Ultimately, look at Europe, how this plays out in practice. The only language that politicians understand is that of the bond market. And so we may have to wait until the bond market very clearly tells the politicians they have to act. And we can act later on. I mean, Greece can engage in reform now. The problem is it's far more painful the longer you wait. And unfortunately, it is quite likely to take quite a few years before we're going to engage in real reform. There's always the hope that we'll do it earlier. But as far as the dollar is concerned, it is that sustainability of the deficit that people are concerned about, and we still have time, but the time is going to run out within a few years.
Interesting. You know, I do look at the Treasury International Capital TIC report just to see if there's enough flowing in to cover that current account deficit on a monthly basis. It's more or less been, you know, it's a little under, but it's close enough. The interesting trend I've seen there is that foreigners are buying less and less and less on the long end, long-term securities, and more on the short end, which is to me is like if you're going to say eventually I'm going to vote with inflation expectations or fiscal crisis expectations, what you're going to do is you're going to start voting by only holding shorter term stuff first. Switching your preference on the maturity scale there. Have you been noticing anything like that, or is that an artifact, or do you think that's a realistic observation?
Well, by all means, and of course, as interest rates may go up or as inflation expectations may go up, anybody who is investing in fixed incomes should consider reducing the overall duration of the fixed income portfolio. It's one of the things we do in our mutual funds. By investing in currencies, that's really a special case of being at the extremely short end of the fixed income curve. We have never had a maturity of over 180 days, for example, in our hard currency fund. And so with such a tool, you can reduce the duration of your overall fixed income portfolio. But what we have seen also on the government side, the U.S. government has run its debt portfolio like an adjustable rate mortgage. Now, luckily, in the last 18 months or so, the Treasury has tried to extend the maturity of that. Now, at the same time, of course, as you point out, buyers of those securities, be they domestic or foreign ones, have been trying to reduce their maturity, and that's a very healthy development. That's a debate that's happening. It's going to be reflected in the rates, and so we have to see how that unfolds. But on the other end of the spectrum, of course, we've had many people chasing yields. The interest rates are so low. 4-week treasurers are yielding in the low single-digit basis points, so 0.02 basis points. At 0.02% you get for giving your money to Uncle Sam for a month. That is just about nothing. And so some investors have been going out on the yield curve, have been buying longer-dated securities in the hunt for yield. And, of course, what happens then is you have money chasing those securities that has no business being there. And the longer-dated bonds can be very volatile in normal times. You don't have to be somebody who thinks of a crisis scenario to envision significant losses if the mood in the market swings. That's typical for the bond market. In recent years, it hasn't happened as much, but the bond market is a volatile place if you buy longer-dated securities.
Interesting. Yeah, it's certainly something I'm following as closely as I can. One of the areas I do spend a lot of time in is commodities, and I've been watching, this recent run in commodities. Honestly, if you take a 10-year chart out of the continuous commodity index, it's been pretty phenomenal. The run we've been on, it's 14% per annum for 10 years annualized. There's a spike in 2008, a dip in 2009, but on average, it's a pretty nice straight line, except for this last recent blow-off, if I can call it that we're in the middle of. To me, this feels like early inflation expectations playing out. It's risk assets coming forward. It feels like late 70s all over again, at least in terms of how commodities are behaving. Are there any parallels there? I mean, how concerned do you think the Federal Reserve is about that? Not even with, including the idea that you put forward, which is the more we drive up commodities and export that sort of inflation through our policies, the more the rest of the world, large portions of it anyway, are unhappy with the results that transpire in their homeland. How much do you think the Fed is paying attention to this? And I know they've come out and said it's transitory. I hate that word because Greenspan called oil prices transitory at $40 a barrel in 2006. Yeah, it was transitory. It transited right past 40 and never looked back. So where are they in this story right now?
The parallels I see are in the tech bubble and in the housing bubble, that for many years the markets move up and up and up, and you have more and more folks come out and justify it and argue that these prices can never come down. I think we've seen historic lows in the long-term mortgage rates, probably last November or so. And the Fed, of course, should be very concerned about it. The problem is that they're running out of tools. And the problem is also that the Federal Reserve can control short-term rates, but in the long end of the yield curve, there is very little they can do. The reason why the bond market is doing what the Fed wants them to do is because there continues to be confidence in the Fed policy. But should the trust erode further in the Fed, and it's been eroding over time a little bit, the cheapest policy, by the way, is just a verbal announcement by a Fed president. Then you have to move to interest rate cuts, emergency rate cuts, buying of securities in the trillions. And so Fed policy, you can implement. It's just getting more and more expensive. And so when the markets don't listen to the Fed is only one participant who's zipping from a straw in an ocean. And the reason is that the bond market, the fixed income market, is just so huge, and it really goes beyond the U.S. market. You can buy other highly rated securities overseas, and they're all very closely linked to U.S. markets. And so the Fed, of course, they can buy billions, even $1 trillion or so. But if and when the market is moving against the policymakers, then there is no stopping. The Fed cannot stem that tide. There is only so much that they can manage. And so it is something that they have to watch very carefully. At the same time, they're not terribly concerned. And the reason they're not terribly concerned is because you only have that one lever. If the bond market is falling, you don't know whether it is because of more economic growth or because of more inflation. And yes, you can look at the inflation-protected securities, but you really only know after the fact. And so for now, people think, oh yeah, we have this economic growth kicking in, until the next economic numbers come in and are not as great as expected. And so it's a bit like a boiling frog syndrome. You print all this money, you think everything is great, and you have some warning signs, but you think, oh yeah, things are moving along. And by the time that you really see the damage you have created, it's quite late to undo this damage, and it's going to be very, very expensive and painful.
Well, let's talk about what I consider to be the key commodity when it comes to these sorts of expectations, and one that I know the Fed tracks very closely, or has historically. I assume they still do. Precious metals, gold particularly, on a huge tear of late, obviously. I think we're over 1,505 right now, and unless it's done something crazy since we started talking. And silver just popped over 45, I believe, and so a huge run following a decade of year-on-year gains. So what's your views on the precious metals? Do you believe in them as an investment at this point, and what's the outlook?
Well, first of all, I'm not so sure how much the Fed really looks at gold. I think everybody has their personal view on the Fed. They're not very happy about gold being that high, but ultimately, I don't think that's the main thing that they look at. It's something they do look at, but not as the main driver. Now, as far as we're concerned, gold is the ultimate currency because it's not so easy to print. It's very difficult to ramp up production in gold. Having said that, it is the one, if you call it a currency, that is more volatile than other currencies because the market is just much, much smaller. If you look at China, they're trying to increase their gold reserves, but they're trying to be pretty well-behaved participants in the market. So as a percentage of the total reserves, gold has been going down because they simply cannot buy enough gold to keep it up. As far as us as a firm is concerned, we have kept gold as a core component in our main strategy. And as far as I'm personally concerned, even before that, I started to accumulate gold. Gold, I believe, will do well as long as we do not change policies in the U.S. that move over to fostering savings and investment. Because until then, we will continue to be vulnerable in the dollar. As long as we continue to fight rather than embrace market forces. And if you look at it, you mentioned earlier, Europe is raising rates. Yes, sure. We have rates at 1.25% in the Eurozone right now, but inflation is running at 2%. So we still have negative real rates, even in the Eurozone. So even though I like the way they pursue the policies, and we can talk about that, it is still something where we have a very accommodating. Also keep in mind, we have a global debt to GDP ratio in developed countries, in the OECD countries, that is at over 100%. We've never had that before in peacetime. We have some minor wars going on, but in generally, if in peacetime, we've never had that happen. Inflation almost certainly is going to be part of that solution, and that is an environment that will continue to foster gold. And because the gold market is so small, that's why we can see these extreme moves that can go far beyond where we are right now. It's very difficult. We saw in the early 80s this major blowout. We have not seen that panic buying, and as long as we still have so many skeptics out there in gold, we like gold. Having said that, be aware that gold is quite volatile, and there can always be a sharp correction. One of the reasons why we prefer gold over other commodities is because, on the one hand, of the simplicity of gold, because it only or primarily has the monetary sensitivity and not so much industrial use, and secondly, because it is far less volatile. Silver can move 10% in an hour. By all means, we like silver, but you've got to have a good stomach in order to stomach the volatility that comes with silver.
Oh, absolutely. Yeah, silver's got an industrial story to me, and one that I actually really like on a long-term fundamental basis. I don't think it has a monetary role simply because there's actually just not quite enough of it on the surface of the planet compared to gold. And gold, you already mentioned, is a small market. Silver's tiny compared to gold. So not very favorable on that run. I'm not a gold bug. I'm an anti-dollar bug, as it were. Gold for me is a way of sidestepping a mismanaged currency. On a fiscal basis and a monetary basis, I have strong disagreements with what we're doing right now. Doesn't look sound. But you hit on the key thing for me, which is as long as rates are negative, I'm very much gold bullish. And I know that there's, the official story is CPI, trim mean CPI core, whatever. But my personal CPI rating that I hand assemble is much higher than the official ones. It's a couple points higher. And so I would need personally to see short-term rates in the vicinity of 5.5% before I would start to feel like they were neutral to positive. I know other people have disagreements and would have different numbers, but that's just to put it in context. I would need to see 500 basis points of interest hikes before I start to become really fundamentally concerned at this point about one of the key supports for gold price.
Well, just as a comment there, think about what were to happen if we were to raise rates to 4 or 5%. And indeed, countries like Portugal, they screamed for help from the European Union because their cost of borrowing was at some point going to 5%. It's gone beyond that since. But still, 5% is not that high. At the same time, if you look at the municipal bond market in the U.S., some people are saying, well, the interest service payment for the municipalities isn't all that high. Well, yes, because they're paying only 1 or 2% on the interest. Let that go up. Let the Fed tighten, and suddenly let that debt servicing double for those municipalities, and then we're going to have very serious problems. One of the challenges of having low interest rates for an extended period is that you encourage everybody to take debt, and not just consumers, but also governments and municipalities. And so what happens is we have a far greater interest rate sensitivity, and that means we are far less shock resistant, be that on the consumer side if you lose a job, or be that on the government side, that it is simply, and all of the budget projections, by the way, by the CBO are based on the current interest rate environment, and it is just unrealistic to think that is going to continue forever. At least there's a substantial risk in that, and the key difference here between the U.S. and the Eurozone, for example, is in the U.S. we have a current account deficit. As you pointed out earlier, we are dependent on foreigners to finance that. In Europe, you don't have that. And so in the U.S. and the countries with a current account deficit, you need to have economic growth in order to attract money, in order to have the currency be strong. In the Eurozone, you don't need to have that. You see that very clearly illuminated in Japan, where the worse the economic performance is, the stronger the yen seems to be. And that is because they finance the deficit domestically when the economy slows down, be that because of an earthquake, be that because they had 6 prime ministers in 6 years. As a result, consumers are saving more. And the 6 prime ministers in 6 years means that they're not effective in spending programs and exerting pressures on the Bank of Japan. So only when they get their act together is the yen going to tank. And so the dynamics work a little bit differently in different countries, but in the U.S. we need that economic growth, and by all means, if we're going to get interest rates to 4 or 5%, that would push us right back into a very severe recession, probably depression.
I agree with that. It really feels like a rock and a hard place. It's a classic bind. It feels like in trying to avoid the liquidity trap, we've gotten ourselves into a much worse trap of a form, and I don't quite see how we get out of this. And so my question for you is how does the average investor preserve wealth during this period of time? It seems, just horribly complicated, and we have to guess a lot, and normal correlations and risk patterns are changing constantly. How do you help people navigate this mess, if I can call it that?
Well, a couple of things that we'd like to point out. One is that we've argued for a long time there's no such thing anymore as a safe asset, and investors may want to take a diversified approach to something as mundane as cash. You may want to consider hedging your dollar risk, be that on your cash side, be that on your equity portfolio. And obviously there are many ways of trying to do that. Basically, you have to look at asset allocation without the risk-free alternative. Everything is risky these days. Now, on top of that, you talked about correlation. One of the side effects of having so much involvement by policymakers is that it feels great when another trillion is spent. The problem is that all asset classes are moving in tandem. So where do you hide when things turn bad? It is great on the day when the market goes up by 200 points, but where do you go when the market goes down? And that's why we have veered over to the currency space, because in the currency space you can design a portfolio where you can have low correlation in your portfolio versus anything else that you're holding there. And also, you can directly play on the policies. Why do you hold a Fiscal? And I'm not trying to have an argument for or against Fiscal, but why do you hold a Fiscal when you have the corporate risk, when ultimately the only reason you buy Fiscal is because you believe in economic recovery? Well, do it on the currency side where you strip out the corporate risk and you can take a position based on the mania of our central bankers and our policymakers. And so more and more investors are embracing that, and it is, people always say, oh my God, currencies are so complicated, but in the end, no, they're much easier because our policymakers are highly predictable, and you only have about 10 major currencies to worry about rather than thousands of stocks. Some people say currencies is a zero-sum game. Well, no, it is not. We are better at printing money than other countries are. So that has very direct implications to the value of the currency relative to one another.
Excellent, because, if there's one thing I'm extremely bullish on, it's the mania of our policymakers. I absolutely agree with that as an outlook. And it's something I've been arguing for a long time. When we look through history, we see very clearly that when presented with the options of either deflating or inflating is always chosen if ever possible. So no reason to suspect this time will be different. So I'm very interested in this idea of how you get people exposed to other currencies, because one of the things I tell people to do a lot is to diversify away from the dollar. And depending on how much wealth you've got, it requires either a little or a lot of effort. I'm interested in the ways that you can help people who want to do that. So how can people find out more about your work, what your investment opportunities are, and really importantly, to follow what you're thinking?
Sure. We have 3 mutual funds, the Merk mutual funds, and the best way to learn about them and get a prospectus and all that is at merkfunds.com, merkfunds.com. I like to stress that we typically don't use leverage. We consider ourselves currency investors, not speculators. Sometimes currencies have a reputation of being highly speculative, but you don't need to be a leveraged player, a speculator in order to make money in the currencies. We have a hard currency fund, an Asian currency fund, an absolute return currency fund. The titles are pretty much self-explanatory, but look on our website and to learn more about them. We have a newsletter there, a free newsletter there where we talk a lot about these dynamics in the currency markets as they unfold, building on what we discuss here. We encourage anybody to sign up there. But go to our website and learn more about them, and then shoot us an email through the website if you have any questions.
Great, fantastic. Axel, I hope that we get to meet again when I come out your way. I know we had an opportunity to meet last time I was out, and really enjoyed that. So I want to thank you for an illuminating discussion today. Just fantastic.
My pleasure. Anytime.
And you know what? I hope you and I are wrong about the dollar, but hope alone is a terrible strategy. So let's plan and act as if we're not. All right.
And by the way, just on that point, we fully agree. We don't have a crystal ball. The question is not whether we are right or we are wrong. The question is there a risk that we are right? And if so, should investors take that into account in their portfolio allocation? I wish to be wrong as well, and we do everything we can to encourage the policymakers to do the right move. But unfortunately, I think there's a risk that we may be right. And if so, you may want to take it into account in your allocation as you allocate your portfolio.
Perfectly well said. I couldn't agree more, and that's how I've been allocating things for quite a while in my own life. So I am hoping for the best, but planning as if maybe that's not going to come about, and structured my portfolio accordingly. So again, hey, thanks again. I really appreciate it.
Yeah, take care.
All right, bye-bye.
This concludes this podcast by Chris Martenson. To gain further insight into where things stand today and what might happen tomorrow, please visit chrismartenson.com. That's ChrisMartenson.com. Please join Chris Martenson next time to continue your journey toward awareness, understanding, and action.